Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Chicagoland Retirement Protect and Grow, brought to you by Chicagoland's CFP certified financial planner Tim Stearns, here with us, founder at TJ Stearns Inc. Tim, always a pleasure. We appreciate the time.
Peter, thanks for having me.
Well, Tim, we know that retirement is a balancing act. On one end of the spectrum, we worry about passing away too soon and not getting to enjoy it. On the other end of the spectrum, we worry about living too long and running out of money. I guess one of those is kind of everyone else's problem, and one of those is our problem. But
right.
I think a lot of people realize that on the first end of that spectrum, on passing away too early, in order to avoid it being our family's problem, our loved one's problem, we can take out life insurance financially to help protect them. But I don't think many people realize that on the other end of the spectrum, we can actually insure retirement income, that it's going to last as long as we need it to, that it's going to be there, that it's going to be dependable and durable. And that's why survey after survey and study after study show that the number one fear of retirees is running out of money.
Right. And if you remember, about 10, 15 years ago, they did a survey of baby boomers, and their number one fear was dying. Then as they got closer and closer to retirement, as you say, now it's running out of money. So that's a real thing. I think a lot of them don't realize that really when they retire, it's still about income. And you need to get ahead of that and make sure you understand how you're going to get an income to pay your bills. So that if the market does take a dip, a precipitous one like it did last March in 2020, you're able to, adjust accordingly because you still have income coming in. You don't have to pull from that growth bucket, as they like to say.
And great point, Tim, that in order to address this concern that retirees have of running out of money, we first and foremost really need to realize that it's not about the money, it's about the income. We need to recognize and respect that need for income in retirement, and how just because we retired, it doesn't mean we don't need an income. It means we don't have that income. We've got to take the steps to replace it.
Right. Exactly. So what I would tell you is that, and what we do with our clients or prospects, a lot of them come from this radio show, is they want to know, how do I get through a 30+ year retirement? And we actually go through the process with them of seeing what their budget is, seeing what their guaranteed sources are. Do they have a pension? Do they only have Social Security? Because most baby boomers, have dealt with 401ks their whole life. So we want to define exactly what that income gap is. All right. The next step would be, well, all right, how much assets do you have? And how do we go about making sure that money, we don't pull out too much and not too little, so that you're not enjoying your retirement?
Again, kind of that balancing act, but we find the correct balance, Tim, through proper planning, not just asset allocation and investment planning, but mixing in and really the balancing side of that is the income allocation and the income planning. And I know that you've stressed the importance of that side of things for years here on the program, Tim, and made what is the really essential reference guide to planning for retirement available to Chicagoland area savers and investors who are serious about their planning and financial future. It sort of explains why we need this balance and kind of a shift in our paradigm when we retire.
Right. So, we cover the whole gamut there. And the thing that I like to offer to people is, number one, for the first 10 callers, that with people that have over $500,000, I'll be happy to get the book Income Allocation out to them. It kind of shows you how to get through a proper retirement, not using asset allocation, which is, to me, is basically a dinosaur strategy. It's a very old, archaic way of looking at investing. And it has failed us 5 times in the last 21 years. So why would I use something in retirement that, I don't that can fail me, and again, we talk to them about different things like sequence of returns risk, interest rate risk, things that, most people are worried about the market, and I get that, and that's one thing, but there's also longevity risk. We have sequence of returns risk, like I said. You have markets that some people assume that the historic is 10%. It's not, and what if you have a lost decade like we did in 2000 through 2010, where the market did absolutely nothing? It started up, went down, went up, and it ended up being right at where it used to be. And I mean, no one signs up for that. And I was with a client just the other day, and we were talking about that. She was with a reputable company, because they're reputable because they're on TV, which is kind of funny to me, because the portfolio she had, I explained to her that my 21-year-old, if you want to invest $25 into a mutual fund, he could have the same portfolio. And she had a lot more money than my 21-year-old. My point being is that they were just doing a buy and hold. And the buy and hold does not work in this current day market at all.
Well, if you would like a little bit more than that buy and hold, or the old asset allocation where we hope that the market works in our favor for the duration of our lifetime, and our very life quality depends on that happening, pick up the phone, give a call, because there are better ways. We can ensure that we have that standard of living and quality of life by structuring in dependable, reliable income throughout retirement. And if you would like that income allocation plan, pick up the phone, give a call. If you'd like the book, Income Allocation, that explains why you need to consider this newer way of planning for retirement, Tim Stearns makes 10 copies of that book available to savers and investors in Chicagoland tuned into this program each and every week. Pick up the phone right now. Give a call, 800-640-2256. That's 800-640-2256. Tim, taking this a step further, as we get into the actual process of the income allocation, I know one of the steps you take is defining the need for income. And yes, that can change over time, but we can find that baseline to begin retirement on a more steady and secure basis.
Right. I mean, so it's literally, in our class, our retirement class, we have a form that I give out to people, and I say to you, who's the oldest person you know? What age do you want to retire? Real simple. So I'll use my mom as an example. So where she lives, I know a woman who's 100. Let's say I want to retire when I'm 65. So 100 minus 65 means I need 35 years of income in retirement, right? This is for my wife and I. It can be a single person too. Then I go and I look what my budget is. Let's say it's $100,000. And between my wife and I, we have Social Security coming in of, let's say, $5,000 a month. So I have times 12, 100 minus $60,000 coming into my house. I have a gap of how much? $40,000. And that shows to you exactly what you need to have to sustain a 35-year retirement. And I think that people they either don't want to handle it, or they think it's way more complicated than it is. But at the end of the day, you need to figure out, how are you going to get that guaranteed income so that if the market does slide on you like it did last March, it doesn't set the tone for a very, very bad retirement.
Now, that is helping us to remove the possibility of market volatility derailing the retirement. But there are other factors to consider here, Tim. I mean, you went through that kind of back of the napkin math equation, and I think that's right where the conversation begins. But there at TJ Stearns Inc., you are a CFP, a certified financial planner, and you take a much deeper dive. You look at inflation and taxation and acceptable cash flow rates, our anticipated rates of return, healthcare, all of those factors go into the planning that you do behind this income allocation.
Right. And we make sure that, we cover the whole gamut. The client I was talking about the other day, the company she was with, they had never addressed anything, like estate planning. They saw her as just a stock portfolio, and it had mutual funds and that type of thing, and bonds, of course, using asset allocation, which, was great in 1954 when it was created, but things have changed in 2021. Things that we've never seen have come around. Stop losses are key, I think. And she saw the light in that. Her portfolio went down 24%. I showed her one of ours that had only gone down 2.42%. So, those are the type of things that when you're in retirement, you are a net seller of assets. You're not going to have more money, unless you have growth. All right. So the last thing you want to do is dip into principal. And that's what she'd be doing. If the market went down, she'd be just dipping into that.
Well, Tim, I know that if you take a 25% loss, you need a much more substantial return to get back just to break even, a 33% rate of return just to get back to break even. I can remember plenty of instances where there have been 25% losses, but it takes some work to get a 33% rate of return. In retirement, you're a believer that with the money that we are relying on for income, we should not be exposing those dollars to that kind of potential for loss because of how difficult it is to make those recoveries.
And Peter, if I remember from one of our older shows, you said that the bull market takes the stairs to get back up, and the bear market takes the elevator.
That's
and that's
right.
Well spoken. The other thing I said to this client, I looked at her portfolio and I said, if the 2008 crisis happened again, your current portfolio lost almost 50%. Are you willing to risk that? And she said, absolutely not. She took a buyout from a company, which you're seeing a lot because of the pandemic. People are cutting, upper management, that type of thing. We're really good at helping people segue. She's only 58, so I have to get her to at least 59 and a half to even touch her qualified money. She's going to need health insurance to age 65. There's a lot of things that go into this. They never even approached her about a long-term care life insurance hybrid, which is amazing that they would do that when 7 out of 10 Americans are going to need it and 9 out of 10 of us don't have it. I don't understand that.
Well, the goal at TJ Stearns Inc. is to help you arrive at a conclusion about how much you need to have saved in order to retire. Do you have enough to retire, or do you need to make further progress to build your savings? Or if you're already retired, how can you ensure that you will have a sustainable cash flow and income that you can rely and depend on throughout your lifetime? And then how much is left over for doing things like the discretionary spending or creating the legacy maybe that you want to leave to your loved ones, your family, your children? What is available for investment that you can take risk with? And what is needed for spending on the essentials to support your lifestyle? That's what the cash flow rate, the withdrawal rate is all about. The Tim Stearns will help you kind of reverse engineer, work backwards, and figure out following that income allocation model. This is the model that has shown more reliable for retirement income and retirement lifestyle confidence. If you would like to find out more about income allocation, if you'd like the book Income Allocation, pick up the phone, give a call. Tim Stearns is willing to provide that to the first 10 callers today with at least 500,000 saved. The number is 800-640-2256. That's 800-640-2256. If you are retirement minded, nearing retirement into the foreseeable future, 5 to 10 years, maybe in that red zone, or even already retired, this book is essential for you to read. Again, it's Income Allocation. It is the retirement planning strategy guide being used across the country by advisors who are helping their clients understand what it takes to face the risks that we will face in the financial world today in retirement. 800-640-2256 if you would like a copy of that. 800-640-2256. And Tim, of course, we can't really have a conversation about retirement income planning without mentioning Social Security. That alone is a big piece, although how much faith we want to put it on being there forever, that's kind of up for debate more than ever now, but we still want to make the most of it. Some people have a problem with the term entitlement. I don't. I've been paying into Social Security for 26 years. I'm 40 years old. I started working when I was 14. I've been paying into it long enough to say that I am entitled to that. And I sure as heck, I want to make the most out of it. I want to get the most out of it that I possibly can. You help people do that.
Right. And that's one of the things that we do. And Peter, I didn't realize you were that young. You're so wise. What I want to say is that we have people.
The grays are showing, Tim.
There you go.
they're hidden underneath the headphones.
What I would say is that you need to do a Social Security report, and we have great reports that can tell people, if you churn on here or churn on there, what you're leaving on the table or what you're taking home. If you've never done that, and if your advisor hasn't offered that to you, why not? There's certain ways we can go about things a better way. Do you wait till age 70? Do you need to take it when you're 62, or do you wait to the middle in there and take your full retirement age, 66 or 67, depending on your date of your year of birth? So that's another thing we'll do for people. There's no obligation. It's really easy to look at, and so that exactly, well, if I took it now, I'm going to lose out on $1,200, down the road, and a lot of them are people have misconceptions about how much cost of living adjustments, COLAs, there are out there. Social Security, when they give you a cost of living adjustment, they strip out certain things like the cost of food and the cost of fuel and that type of thing, clothing. And then they say, well, there is no inflation. So that's why they give you less than what inflation is bearing right now.
Well, except on healthcare, which is why we also have to increase your Medicare premiums, right?
Amen. Exactly.
They give it on one hand, maybe, but they take it right back on the other.
Right. And I was talking to a client just the other day about IRMA, income reduction that you get from Social Security because you're bringing too much money into the house. So if you're a saver, the federal government penalizes you by charging you more for Medicare based on your income, which, to me is very unfair. And that just started a couple of years ago, but people are unaware of it.
Well, Tim, I know that the difference between a well thought through, informed decision and optimized decision on when and how to claim and collect Social Security versus possibly an impulse decision or a poorly timed decision can literally mean the difference in several hundreds of thousands of dollars over kind of average life expectancies and possibly even more than that if a married couple live beyond life expectancies, which about half of us do. And so why would we want to have to generate that extra money from our own personal savings and our own portfolio when, as long as we've thought this through the right way and gone through this report and analysis, we could actually generate that money from Social Security, which we are entitled to?
Exactly. So why not use it, right? And I mean, you don't want to go in there blind. It's interesting, on their website, they literally have a thing that says in 15 minutes, you can claim your Social Security or less, 15 minutes or less. I've been told that a lot of the Social Security Administration, some of the employees aren't very helpful, or they get different answers when they call.
But it's not their job either. I mean,
Right. No,
they're
of
not
course
there
not.
to provide guidance. They don't know our situation, and therefore it probably would border on malpractice for them to provide advice.
Right. So what I tell people is, if they want help with that, we'll help them turn on their Social Security so it's done the right way. Or better yet,
But can you do it in 15 minutes?
No. You figure you put your 35 highest earning years into there, and you're going to only take 15 minutes to get that done. That's crazy.
Yeah. Well, Tim, I know another aspect of the income allocation plans that you help people put together. It focuses on taxes as well. And yet again, here's an area where we can sort of default to the plans that the IRS has in place and in store for us, or we can be proactive and strategic. And that also can sometimes make the difference in several hundreds of thousands of dollars or more over the course of our lifetime, and certainly on legacy if we do leave something behind.
Well, I mean, you look at most people with taxation, they're reactive. And we always tell our clients, we have a CPA on staff here. Let's get proactive. Is right now the time to be doing maybe some conversions, so you're not paying heavy taxes or being subject to that IRMA, the income reduction that I was talking about with Medicare and that type of thing, where they reduce what your take home is in Social Security because you're paying more for Medicare. So these are the things that we try to help people with. And, taxation, your number one bill in retirement is taxation. The next one usually is health insurance. Well, both of those we are certified in and licensed, so we can help people with all that.
And then the number 3 might be inflation, Tim, the silent thief. I know with the income allocation plans that you structure, you can help people actually build in automatic increases in income, or sometimes just potential growth for the income. It's like pay raises in retirement. How good is that?
Right. I'm a lot of times if I see a do it yourself income allocation kit, they haven't really taken into inflation, and that's something that obviously every 23 years, your dollar needs to double, okay, to stay up with inflation. So one of the things we show in our class, my retirement class, we have them at Roosevelt University and also Harper College. Basically, we show the Sears catalog from 1976 where you can install 4 tires for $200. I just bought tires for my son, Jake, and they were $900. Nothing fancy, but something safe that, he can get around to school on. And, that's what the dollar does, with inflation. It goes up extraordinarily.
Yep. If you're buying lumber, you needed your dollar to double this year.
Right. Right.
Well, If you have questions or concerns about your income plan, whether it factors in maximizing Social Security, whether it factors in minimizing taxation, whether it factors in the pay raises that you will need throughout retirement to combat inflation, pick up the phone and give CFP certified financial planner Tim Stearns a call. He is willing to put together that protect and grow plan. It does as it's named, helps you protect and grow your assets and your standard of living, the income that you will need to rely on throughout retirement. It is a snapshot of where you are currently, a discussion of your goals, writing those down, documenting them so you know that you're working to achieve them. And then Tim Stearns, a qualified, experienced, certified financial planner, will put together recommendations, a timeline of executable action items, steps that you can take in order to achieve your financial goals. He also makes the book Income Allocation available if you'd like to get started by reading that important reference and resource. 800-640-2256. That's 800-640-2256, the number to call. 800-640-2256. And by the way, no cost for the Protect and Grow plan. If you are willing to invest your time, Tim is willing to donate his time to make sure that you've got a plan in place. Cost should not be a hurdle or an objection to not have a plan. You've got to have that plan. And from there, you can talk about implementing that plan with Tim's help. If you would like, if you find that the assistance has been beneficial to you, that may be something you want to consider. But at least you have that plan in your hands and you can refer back to it. So again, if you'd like that Protect and Grow plan, 800-640-2256 is the number to call. 800-640-2256. Tim, I remember several editions of the program ago, you brought this report. It was the 7 financial myths,
Right.
common mistakes or missteps or misconceptions. One of them on that list was that we no longer need life insurance once we retire. And I think that, we may be able to convince ourselves of that, but there are certain values that life insurance can still play during retirement. It's probably necessary for all of us at some point in our financial career and our life's progress that we have some kind of life insurance. Perhaps at retirement, we could potentially convince ourselves that it's no longer needed. But having the insurance on the baseline of income, even for somebody who's got a high net worth, is rather affluent, being able to do more with less and leverage the money that we are going to need to live off of and have it produce more income for us, I think is attractive to anyone.
Right. And I think people don't realize that if God forbid something happens to their spouse, A, a pension can go away, or B, half of Social Security can go away. And that's, life insurance would certainly help shore up that need. I mean, how many times have you seen a widow or widower moving because they can't afford where they used to live? So the other thing I will say again and again, I love these new life insurance policies because there are living benefits on there, where you can actually use the money for long-term care or towards it. If you can't do 2 of your activities of daily living, it can kick in after 30 days to help pay for that. And again, 7 out of 10 Americans are going to need this, and 9 out of 10 of us don't have it. And if you saw that with people with a car, you'd think you're crazy, or a house, you're crazy. Well, guess what? The chances of you using your home insurance for a fire are far less than you using for, long-term care and that type of thing.
But even with home insurance or car insurance, Tim, if I've got a $300,000 home, I don't set $300,000 over here in an account and say, well, that's my insurance policy in case my house burns down. I leverage my money. I buy insurance so that a small amount of cost and investment can leverage to protect the asset that I am trying to insure against. And the same thing is true with our retirement income and the life insurance component. Either side of that spectrum that we talked about balancing on, you can leverage your money, and a smaller deposit can create more income for you throughout retirement, or you can protect with a larger lump sum with the life insurance side of things.
Right. And, it's been talked about that they might move the estate tax down under $3 million. That remains to be seen. But if they do that, it's another great way to pay estate taxes. The estate taxes as they stand right now, it's 40 cents every dollar you're over the limit. So that's a lot of money. This would be a great way to do it. Plus, one other thing we didn't talk about, these life insurance policies also have cash value. and they're treated like Roth income. So it won't hurt you with Medicare or taxes and that type of thing. And I think that's another thing that's missed by a lot of people.
All kinds of talk and language right now about taxes becoming less favorable in the future. And Tim, that estate tax, by the way, that's on dollars that we've probably already paid tax on multiple times. We paid tax as it was brand new income, and then we invested it to grow to a certain level. We paid capital gains taxes as that went along, and then we pass away, and we've worked hard to build this net worth that we want to pass to our heirs, and Uncle Sam comes along and takes almost half of it after we're gone. They said two things in life are certain: death and taxes. Well, sometimes I feel like we're just taxed to death.
Right. Ben Franklin was right. He said that. That's totally true.
Again, these are factors that we can plan for and we can address in planning. You can't control what's going on in Washington. You can't control what's going on in the market, but you can control how you plan to address those variables that are outside of your control. And that's what the Protect and Grow planning process is all about, ladies and gentlemen. Pick up the phone, give a call, request a time to sit down with a certified financial planner, no cost, no obligation, or call right now and get the book, Income Allocations, in your hand. 800-640-2256. That's 800-640-2256. Tim Kiplinger recently put out an article. You are not ready to retire until you can answer these 7 questions. Now, 3 of them were kind of life style. Are you really ready to quit? What are you going to do with your time? Where are you going to live? But the rest of them, how much is enough? How are you going to pay for healthcare? Do you have a budget and spending plan? And have you maximized Social Security? Those are things that you specifically address through that Protect and Grow income plan.
Yes, we make sure. If you saw our I'll call it a fillable questionnaire that we have that we can email to people, we cover the whole gamut. I mean, A to Z. There's nothing that is lost on there. Estate planning, taxation, medical expenses, dreams, aspirations, what they currently have going on, what assets do they have. We cover the whole gamut so we can make them a good, concise income allocation. And it's garbage in, garbage out. If we get bad information, it won't be a great plan. But if we get really good, concrete evidence of what they have going on, that gives us a snapshot of today and what it will look in the future, we can really do a lot of work with people and make it great.
Pick up the phone, give a call. Tim Stearns, Chicagoland CFP certified financial planner, standing by. 800-640-2256. If you would like that book, Income Allocation, in your hands, call now. First 10 callers with over 500,000 saved can also request that physical copy mailed out to you. Digital copy you can immediately download. You can come by and pick it up. But this is an essential retirement planning strategy guidebook teaching you how to address the risks and leverage your dollars. 800-640-2256. Tim, we always appreciate the time. Thank you for being here as Chicagoland CFP on Protect and Grow.
Here, thanks for having me.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.